History is a subject that investors like to ignore, but history has a habit of teaching very important lessons. And what you can learn from history is that the stock market goes up and it goes down. It goes down a lot. In 1926, a company called Standard Statistics formed the first 90 stock composite price index that got updated daily. Over the years, that index grew and developed, and in 1957 it became the Standard & Poor's 500. And since 1926, the stock market has had a correction of 10% or more on average every year and a half. That is a lot of corrections. Every 18 months, on average, the market goes and takes a tumble. Out of these tumbles, a bear market, where the market drops by 20% or more, has happened every 4 years, and a market crash of 30% or more happens once every 10 years on average. So every 4 years, the market is going to have a 20% decline. And some of these declines are going to be particularly ugly. That is all you need to know. Sometimes the market will go down, and so will the value of your investments. If you are not happy about that, or if you're not ready for it, you shouldn't invest in stocks. The fascinating thing is that it is great when that happens. If you like the stock at $150 and it goes down to $40, that's amazing. If you have done your homework, if you understand the company that you are investing in, if you have done your due diligence and the company is doing great, you might have a $300 price target for the stock, and going from 150 all the way to 300 is great, but going from 40 to 300 is phenomenal. Your only job as an investor is to use these declines in the market to your advantage. Nobody knows when they will happen, how far down the market will go when they do happen. Nobody knows exactly where it's going to go. 18 months ago, we didn't see when and how inflation would arrive, and we didn't know that Russia is going to invade Ukraine, setting off a global energy crisis. 18 months before that, we had no idea that the biggest pandemic in 100 years would shut the whole world down. There is always something happening that we don't know will happen. Right now, we have absolutely no idea what will happen in the next 18 months. No idea. People will tell you that they know and that they perfectly predicted it, because if you predict a market crash enough times, then eventually you are going to predict it perfectly just before it happens. But your job as an investor isn't to read tarot cards or become a fortune teller. Your job is to use every opportunity you are given to your advantage. If you invest consistently over a long period of time, these are the times when you will be making the vast majority of the money that you will ever make in stocks. You won't know it at the time. You're not going to go home and celebrate, hey honey, I've just bought the best value stocks in the next 2 decades. But it will happen. There is something that you really have to know though. Not everything with a yellow discount sticker on it is a good buy. Not everything that you see in the discount aisle needs to end up in your shopping basket. Sometimes things are in that discount aisle for a reason. Maybe people don't want to buy it, and there's a really good reason why. Just because a stock has fallen by 50% does not make it automatically a good investment. You know that you bought a stock at $25 and it goes down to say 10. You think, how much further can the stock go? Surely this one is a winner. I remember when Blockbuster went from $25 to $10 and people said, here is an amazing opportunity. The company had 10,000 rental stores across the US, earned billions of dollars in revenue, and was growing. If the stock dips below $10, it is an absolute steal. And in 2005, it did go below $10. It went all the way down to $5. And there was a frenzy at the time because this super popular brand that everyone loved was selling at a massive discount, just $5. And 2 years later, it was at $3. And 1 year later, it was down to $1. And 1 year after that, it went bankrupt. You should never buy a stock just because of the price. In fact, the way to think about it is that you should buy stocks in spite of the price. A sudden drop in value is a warning flag. It's a warning to you as an investor to take caution and understand what is driving the drop as much as you possibly can. I have owned many stocks over the years that have lost 20%, 50%, or even 80% of the price at which I bought them. I had those stocks before. I have some of them right now in my portfolio, and I will have a lot more of them in the future. And sometimes you might have to take a loss. Maybe you got it wrong. Maybe things changed more quickly than you saw them coming. Maybe you didn't anticipate something happening. If you haven't invested in a losing stock before, then you haven't invested long enough. But there are other times when you look at a stock And you just sit there scratching your head. A company may be selling at a valuation that would seem absurd a year ago, but there it is. Nothing has changed. In fact, the company might have grown in that time. Maybe they now earn more revenue. Their balance sheet is more healthy. Their outlook is brighter. They have more customers. But nobody wants to buy the shares at an 80% discount because there is one human emotion that is even more powerful than greed, and that emotion is fear. Because a lot of people will look at a stock that has gone from $150 down to $80 and buy it just because it's great value. But what are you going to do when that stock goes down to $50? What will you do when it goes to $40? What are you going to do when it drops to $30? A lot of people will be driven by fear and they will sell their stock because they never understood why it was that they bought it in the first place. The stock has dropped, and when you're basing investing decisions on some kind of guesswork framework, you do not know what to do. And you go and listen to some advice on YouTube telling you exactly where the stock or the stock market overall is going. Is that what you're going to do? Do you go and do some technical analysis to make yourself feel better? What are you going to do? Back in university, I studied mathematics. One of my favorite subjects when I studied mathematics was dynamics and chaos theory. And the stock market is a fascinating example because in the short term, the behavior of a stock market can be described as a highly chaotic deterministic system with a very low lap-on of time. Basically, it just means good luck trying to predict what it's going to do. But in the long term, the dynamic system of the stock market changes massively. Its sensitivity to conditions and exogenous factors and small effects like news reduces drastically, and its long-term topological vector space becomes dense. And this means that all the short-term fluctuations that you see moving things up and down become largely irrelevant when you zoom out long enough. Because at that zoom level, other factors become dominant in terms of what's driving the long-term behavior. These are things like human productivity, growth in population, growth in innovation. And these mean that corporate profits will go up just like they have gone up. They've been going up by about 9% a year on average because humans are a collectively productive and hard-working kind of animal. The stock market will continue to go up and go down. And when the market goes down, it is an opportunity. It is an opportunity that most investors will squander because they don't understand what they are investing in or why they are investing in it. The unfortunate truth is that if they don't understand what they are investing in or why, then they probably should not be picking stocks in the first place. I know it's really cool to go and pick your own stocks, be that massively awesome investor, but there is a very good reason why most people who do it will lose compared to just investing in an index fund. For most people, investing in the index fund is by far the best option. And because of that long-term stock market behavior, the stock market tends to go and double in value roughly every 8 years. I haven't got the foggiest idea where the market is going to go tomorrow or when the market reopens on Monday. And the truth is, nobody else knows either because the system is impossible to forecast. There are far too many individual variables to consider that each plays a part, a bit like the butterfly effect. But then on top of that butterfly effect, there are millions of people out there playing the guessing game, trying to predict themselves what the butterfly effect is going to do. And they're trying to predict it and making investment decisions and trades on the back of that is adding a whole different layer of effect that in itself is affecting the price as well. That adds a whole different layer of unpredictability. What did the market already price in? When did the market price it in? Why did the market price it in? I don't know where the market is going to be next week, where it's going to go next month, or even next quarter, but I have a very reasonable confidence that the market is going to be order of magnitude roughly 8 times the size in 25 years. And in those 25 years, the market is going to fall a lot. And I am going to pick a massive number of losers in that period. And there will be economic and political crises, which will feel like the worst ever crisis that we've ever had at the time, believe you me. And every single time, that time will be different, and the old rules will not apply, apparently. If you make a bad investing call with $100, then you can only get to lose the $100. But if you invest that $100 and you are right over the long term, you can make $200, $500, $1,000. The great thing about investing is that you don't have to be right every single time. Nobody is. The greatest investors of all time only get it right 6 times out of 10. And in the cases where you do get it right and the company is doing great and you see a huge upside, that is where the opportunity lies. The question is, will you take advantage of those opportunities? When the market is going up, everyone is a long-term investor until the market starts going down. And then suddenly, many of these long-term investors very quickly reclassify to become short-term traders. It's truly fascinating. The question that you have to ask yourself is, what are you going to do when the market goes down?